I'm Craig Popp with Accrue Wealth, and this is your fourth quarter and 2024 market commentary. U.S. equities were higher in the fourth quarter, with the S&P 500 delivering a 2.4% return. One major highlight was that all 4 quarters of the year were positive. The last time that happened was in 2021, and the markets ended the year with its 5th straight positive quarter of return. The fourth quarter return was the most muted of the 4 quarters. November delivered almost a 6% return, the best month of the year. The month was fueled by a 2.5% gain on November 6, following a smooth and uncontested election. It was the strongest post-election day performance dating back to 1928. Small cap stocks also rallied in the post-election period, closing at an all-time high for the first time in 3 years. The last record-setting day was in November of 2021. Unfortunately, a poor December gave back most of the post-election gains and ended the fourth quarter essentially flat. Despite ending the year with an 11.5% gain, 2024 marks the 8th time in 10 years that small cap stocks underperformed their large cap peers. The S&P 500 was a top performing equity market in 2024, gaining 25% and setting 57 fresh record highs along the way, although we finished somewhat below the most recent high on December 6th. This was the second consecutive year the markets delivered 20+% gains, marking the first time this has occurred since 1998. Mega cap tech stocks powered by strong earnings and rising capital expenditures were a key contributor and delivered outsized gain. Once again, the famed Magnificent Seven accounted for roughly 57% of the S&P 500 annual return, and about 60% of the return achieved over the last 2 years. Nvidia alone accounted for 22% of the 2024 return. Given the high degree of concentration, it has been challenging for diversified portfolios. While the S&P 500 is up 25%, the average name was up only 13% in 2024. Furthermore, approximately 30% of S&P 500 constituents finished down for the year, and about 28% of constituents are in a bear market, which we define as off 20% or more from its highs. And nearly 2/3 of constituents are down over 10% from their respective 52-week high. Turning to fixed income, the Bloomberg U.S. Aggregate Bond Index delivered a negative 3.1% return during the quarter, declining for the first time in 3 quarters, and it posted the largest quarterly decline since the third quarter of 2023. Rising rates weighed on overall returns. Despite the quarterly decline, fixed income rallied on a full-year basis and was up 1.3%. The second consecutive year of positive return. Conversely, high-yield bonds eked out a 0.2% return during the quarter, the 9th consecutive quarter of positive return, which is the longest streak since the third quarter of 2007. Given the risk-on quarter for stocks, I am not surprised to see high-yield post a positive return. High-yield spreads narrowed intra-quarter to the lowest level since 2007. In 2024, the 10-year Treasury yield rose 70 basis points, ending the year at 4.58%. As a reminder, 100 basis points is equal to 1%. Treasury yields rose across much of the curve in 2024, aside from the 0 to 2 year maturities, with a sharp move occurring higher in the fourth quarter. Ultimately, the Treasury yield curve moved to a normalized slope in 2024 as the 2 to 10 year spread shifted from negative 37 basis points to positive 34 basis points, ending its 26-month period of inversion. While yields have been steadily climbing since 2020, it is unusual for yields at the long end of the curve to increase so soon after the Fed initiated its rate cutting cycle. Typically, as the Fed lowers its overnight policy rate, yields at the longer end of the Treasury curve are steady or lower. But after 100 basis points of cuts to the Fed policy in 2024, the 10-year rose almost 100 basis points, closing the calendar year at its highest level in 18 years. Investors are likely to find continued value in the income component of bonds, as the rising yields of 2024 offer investors historically attractive income levels to start the new year. With the yield on the U.S. aggregate index at 4.91%, well above its 5-year average of 3.24%, and with the average yield across the Treasury curve of 4.45%, income should not only provide a reliable source of return, but also help cushion against market volatility. Thank you for your trust in us. Contact me with any questions.